Bismillah ar-Rahman ar-Rahim. Hello, my dear friends and students. In this video, we want to talk about the corporate governance. What is corporate governance? What is the purpose of corporate governance? How we can manage the corporate issues, especially agency problem and so on. How the directors and the managers become accountable for the shareholders and so on, right? But in order to explain the corporate governance, first of all, I have to discuss about the regulatory framework. Why? Because the corporate governance is also one of the part of the regulatory framework. First of all, let us say what do you mean by regulatory framework. Regulatory framework basically talks about the accountability of the directors and managers against the shareholders against the all stakeholders, especially shareholders. It means how the board of directors and managers should be accountable for the stakeholder, especially shareholder. Regulatory framework insists or focus on this one that how we can protect the economic interests of the shareholders. Regulatory framework insists on this one that how we should provide a fair and true report, especially financial report about the performance of the business. Regulatory framework focus on this one that how we can increase the confidence of the shareholders on the report that we provide in the form of financial report or financial statements. So in order to have a proper regulatory framework or to be implemented in the business, so we have to follow these two things. Or in order to have the goal of the regulatory framework, so we have to follow these two aspects. One is the financial statements and the next one is the corporate governance. It means that in order to achieve the goal of the regulatory framework, which is accountability, confidence of shareholders, protect of economic interests of the shareholders, and of course to show the fair and true financial information about the business. So we have to number one, prepare financial statements. For example, we have to prepare income statement, we have to prepare balance sheet, we have to prepare the cash flow, fund flow, of course, the owner equity statement, several disclosures, and so on. But what is the point? Even if you prepare the financial statements sometime might be wrong, and it may not show or it may not disclose the exact picture of the business. So how we can have a proper picture of the business? In order to have the proper picture of the business in the financial statements, so we have to follow national standards and regulation as well as international standards and regulations. So each country has their own rules and standards for accounting, for a stock market, for several, for example, banks and so on, right? So in order to have a proper financial statements or the financial statement would show the exact picture of the business, so we should follow our national financial reporting standards, several other legal regulation. For example, we can say stock market regulation, exchange market regulations, so company law and so on. Several rules and regulations are nationalized. As well as we have to follow, for example, international standards as well. For example, International Financial Reporting Standard, IFRS, GAAP, for example, generally accepted accounting principles, right? All those rules and regulations, standards, and principles should be followed in the financial statements. And after that, we can accept that yes, this information which are provided in the financial statements are true and it showed the exact picture of the business. One point. But this is not, of course, in our course outline. So this is the part of the some other subject like intermediate accounting, advanced accounting, and so on. Accounting topics simply. But if you like this one, so you can go through my channel. This is my YouTube channel. You can find out information regarding financial statements as well as several regulation. So our course outline or to this topic is this one to discuss about the corporate governance. What is corporate governance? What is the relationship between the directors and of course the shareholders of the business? What is the purpose of corporate governance and what is the objective of corporate governance? So now we want to talk about the corporate governance, the objective, the purpose, and so on. Now let us see each of them one by one. But of course, we will not discuss about the initial part. First of all, let us talk about this one. Corporate governance. A simple definition for corporate governance is given here. What is corporate governance? Corporate governance refers to the system by which corporations are managed and controlled. The way that we can control the corporation can be called as corporate governance. So please remember, corporate governance is not a, for example, organization. It is just a system, right? It is just the way of managing the corporation. How you can manage the corporation in a better way in order to protect the economic interests of all the stakeholders, especially shareholder, that can be called as what? As a corporate governance. In corporate governance, of course, as it is mentioned in the second line, it basically talks about the relationships, how we can have a good relationship between the managers, or we can say directors, and the shareholders of the business, right? So how we can have a good relationship. And through this relationship, we should achieve the goal and objective of the corporation. Goals are, of course, set by the shareholders, and of course, it is the responsibility of the directors or the manager to achieve that goal. If they could not achieve the goal, of course, they have to provide a report why the goal is not achieved. But before to talk about the corporate governance in details and show, for example, what is the objective of corporate governance, the purpose of corporate governance, how we can control the corporation and so on in a better way, first of all, I have shown this relationship in the form of a graph. See, at the top, of course, we have shareholder. Shareholders, if you don't know who are the shareholders, shareholder means those who purchase the share of the corporation. And what is share, we will discuss in the class as well, but share means the unit of the organization which shows the ownership in the business, right? It is the unit of ownership in the business. Anyone who purchases it, that can be called a shareholder. So in the corporation at the top, we have shareholder. Then shareholders, of course, they are owner of the business. And this set objective or goal for the business. These are my goal, so you have to achieve the goal. So in order to achieve the goal, the directors, of course, in most of the case, they are not able or they are not eligible, may not be eligible to manage the business. In order to manage the business, so they delegate the control for the directors. So they hire the directors on their behalf. So they hire the directors in order to control their business and achieve the goal of the shareholder, right? So what is the point? Shareholders, owner of the business, they are owner, they set the goal for the corporation. In order to achieve the goal, they hire the directors. And directors, of course, should control the business and achieve the goal of the shareholders. But what is the point? Sometimes the goal which is achieved by the directors does not match with the goal of the shareholders. It means shareholder expect something else, but the directors do something else. So this is the point that there should be a system, there should be a way to control this conflict of interest. So for this purpose, there is a topic by the name of corporate governance, or there is a way, or there is a system that how we can solve this issue. Why? Because the shareholders expect something else, but the director achieves something else. So they prefer something else, which they may prefer their own personal financial interest above of those people. So in this case, there's a conflict, so there should be a system to solve this issue. And for that one, there's a subject or there's a system by the name of corporate governance to solve it. But even before to go for the corporate governance, first of all, let us explain or define the relationship between those two people and what do we call for this conflict of interest between those two people. See, the point is here. The shareholders who hire the directors can be called as a principal in the business. What do we call it? We call it principal. Shareholders are called principals. Why? Because they are owner of the business. And on the other side, we have managers. Managers are the people who are hired by the shareholders or who are hired by the principals to manage the business, right? So what is the point here? In this case, shareholders, as they are owner of the business, they can be called as a principal. And the managers who are hired who are hired by the managers, sorry, who are hired by the shareholders to manage their business on their behalf can be called as an agent. So managers can be called as an agent and owner can be called as a principal. So this relationship between the directors and the shareholders can be called as which relationship? Agency relationship. Now let me summarize it once again. Directors can be called as an agent in the business. Why they are called as agent? Because they are hired to do something on the behalf of someone else. And you have studied these things in the contract or we can say in the business law. But the shareholders can be called as a principal. The relationship between the principal, it means the shareholder, and the manager, or we can say the director as an agent, it can be called the agency relationship. So this is very simple. Now what is the point here? Sometimes there is a conflict of interest between the managers and the shareholders in the business. For example, shareholders want something else, but the directors want something else. So when there is a conflict of goal between the shareholders and the managers in the business, this problem can be called as which problem? Agency problem. This conflict of goal between the firm's manager and the shareholders is often referred to as the agency problem. What is agency problem? When there's a conflict of interest. Shareholders want something else, but the directors want something else. So they want, for example, suppose, let's take a simple example. Suppose shareholders want to open a new branch, for example, in Jalalabad, but as director is from Mazar Sharif, so he want to open a new branch in Mazar Sharif. Although if we open the new branch in Jalalabad, so it may give us more economic benefit for the company, more return may generate for the business. But the director says from Mazar Sharif, so he preferred to open the new branch in Mazar Sharif to take their own personal interest or to interest for that locality and so on. In this case, finally, of course, the interest may go for the directors instead of the shareholder. So there was a conflict. So directors want his own profit or his own interest, but the shareholder want the interest of himself or themselves in the business. So there's a conflict. This conflict can be called as what? As an agency problem. When there is an agency problem, of course, there is an agency cost as well. What do you mean by this one? Let me define it. Agency costs occur when a company's management or agent place his own personal financial interest above of those shareholders or principals. When directors or when the manager prefer their own personal financial interest above of those shareholders, as I said, for example, in the case of new branch in Mazar Sharif and Jalalabad. So directors want to open new branch, for example, in Mazar Sharif to hire, for example, their brother, their relatives in the company, to do some favor for their localities and so on. So in this case, finally, the profitability of the company might be low. So if the profitability of the company is low, this is basically because of this agency problem. So due to the agency problem, due to the conflict of interest between the managers, directors, and the shareholder, finally the profitability of the company decrease. Why? Because the directors prefer their own interest. So this decrease in the profitability can be called as well as an agency problem, as an agency cost. There are two types of agency cost. Agency cost can be direct cost or agency cost can be indirect cost. Agency cost, which is direct. Direct agency costs are those costs which happen because of the following things. What do you mean by this one? The cost incurred if the agent used the company's resource for his own personal interest. It means in this case the directors directly use the resource of their business for their own personal interest. You can give example of these rangers which are used by police and so on for their own personal interest, right? So they use it for their family. They, for example, carry their family from one location to another location and so on. So this can be called as a direct cost. Directly use the resource of the business for themselves. For example, another example. Suppose you have a manufacturing company. Suppose you have a construction company, for example, and there are several managers, several engineers, and architects, and so on. In this case, the director of suppose this manufacturing, this construction company may call upon one of the engineer, please design a map for the director himself. So in this case, the director directly used the resource of the business for himself, which is the manager, which is the engineer, right? So like that, he may use the car of the business, he may use the machine of the business, he may use land and building, he may use bank account of the business directly for his own personal interest. So that can be called as what? As a direct cost. And what is indirect cost? Indirect cost means those techniques and other method that principal or we can say the shareholder use in order to prevent or in order to detect the agency problem in the organization, that can be called as what? As an indirect cost. So please remember, so relationship between directors and shareholder can be called as an agency relationship. When there is a conflict between these two, can be called an agency problem. Finally, the result of agency problem, there is a cost, and that cost can be called as agency cost, can be direct cost, can be indirect cost. Now the point is, in order to control the agency problem in the business, as I said before, there should be a system. And of course, there is a system, and that system can be called as what? As a corporate governance. Corporate governance comes in this scenario in order to solve the issue, in order to control the directors, in order to control the managers, to please do not prefer your own interest. Please prefer the economic interest of whom? Economic interest of the shareholders. So for that purpose, we have to study what is corporate governance. So corporate governance has its own purpose as well as corporate governance has its own objective. The primary purpose as well as the supporting purpose. The primary objective as well as the supporting objective. First of all, what is the purpose of corporate governance? The primary purpose of corporate governance is this one. Let me read it, then I will explain. Monitor those parties within a company who control the resource owned by investors. See the point. Monitoring those parties who control the resource of the organization. It means the purpose of corporate governance is to control the directors. Directors are the people who control the resource of the business owned by the shareholders. Huh? Of course, there are land, buildings, machines, cash, equipments, everything is there in the business and they all belong to the shareholder. So the directors are controlling that. So in order to check that whether the directors are controlling those things properly or not, we have to monitor the directors. Once again, let me read it. Monitor those parties within a company who control the resource owned by the investors. So the primary purpose of corporate governance is to control those people who, or to monitor those people, or have the oversee of those people who control the resource of the business. Number one, and of course, the other supporting purpose of corporate governance is this one. Ensure there is a suitable balance of power on the board of directors. Yes, check that whether the board of directors use their power within the limit or not. So they should use their power within the limit, not above the limit, right? Why? Because they are agents and there is a agency rules and regulations that you have the power to act on the behalf of the principal, but there is a limitation. You cannot go above those limitations. Number one. Point number two, ensure executive directors are remunerated fairly. Remunerated simply means benefits. In this case, for example, salary, commission, fee, and so on. So make sure that the executive directors are remunerated fairly. Basically, see, in the business, there are two types of directors. Some of directors can be called as executive directors. Some of directors can be called as non-executive. So non-executive directors are those people who are not always available in the business. They are in contact with the business, they participate in the meetings, decision makings, and so on, and they receive their fee. But executive directors are those people who are always available in the business and they always participate in the decision making. So this point is here, make sure that they receive the exact amount of salary, fair amount of salary. It means not more than the standard. Suppose if the standard is 2 lakh Afghani, for example, they should not receive more than 2 lakh. They should not receive, for example, 3 lakh, 4 lakh, and 5 lakh, right? So please make sure that they receive the exact amount of salary, fair salary. Point number three, make the board of directors responsible for monitoring and managing risk. Yeah, this is also very important. So make sure that the directors are responsible for managing and controlling risk. Whether the directors manage the risk of the business or not. Risk in the case of investment, risk in the case of, for example, giving loan to some people, risk in the case of expanding the business, introduction of new product in the market, hiring of some people, firing of some people, yeah. All this type of risk should be controlled by the directors. So we have to make sure that whether the directors manage these things in the business or not. This is important. Next point, which is also very important, is ensure the external auditors remain independent and free from influence of the company. Yes. Who are the auditors? Auditors are the people who come in the business and check the accounts or check the financial statements of the business, whether it is fair, whether it is true or not. So in this case, we have to make sure that these external auditors are independent. It means they are not under the influence of the company. It means they should say independently, they should not be under the influence of the directors, right? So they should disclose the reality and the actual figure of the business. One point. Next point, which is very also important, is this one. Address other issues, for example, like business ethics. Yes, make sure that business ethics is followed in the business, and you know what is business ethics. Make sure that the company follow the corporate social responsibility or CSR. And of course, the last one, which is also very important, protection of whistleblowers. Whistleblowers are those people who are inside the organization or outside the organization, and when they find any problem, when they find any fraudulent or fraud in the business, so directly they raise their hand and they disclose it publicly that there is a problem, please solve that issue. So those people can be called as a whistleblowers. So one of the responsibility or purpose of corporate governance is to protect those people. اتو باز نشوه که او بیچاره را هر کس که صدای خود کشید بیچاره بدر افشاگری کردی بوده چی کنه در بندی خانه پرته مثل که بعضی موضوعات در کشور ما شما میگه میشه یگان تا یگان موضوع افشا میکنه مستقیم وارد زندان چی میکنن مندازن برو بدر چوری افشا کنی درست است. So the purpose of corporate governance was this one. Point number one, control those parties who control the organization resource. Make sure that there is a suitable balance of power. Directors receive the exact amount of salary. Of course, they are controlling the risk of the business. Outside directors are independent. And of course, the whistleblower should be protected. Corporate social responsibility should be achieved. Ethics to be followed in the business and so on. On the other side, we have objective also for corporate governance. Objective means what they want to achieve in the future in the business after implementation of the corporate governance. So the primary objective of corporate governance is this one. Contribute to improve corporate performance and accountability in creating long-term shareholder value. The main objective of corporate governance is this one, to increase or to improve accountability in the business. It means the board of directors should be accountable for whom? For the shareholder, in order to increase the value of the company, in order to increase the value of the shareholder. Value of shareholder means, in this case, wealth of the shareholder, wealth maximization. So wealth or DROE should be increased in the business. If there is a good accountability in the business, everything is proper, we are doing, it means shareholder, if it means directors are doing for the interest of the shareholders. So finally, the value of the company, the value of the shares, the wealth of the shareholder will increase. That is my main objective of corporate governance. Several other supporting objectives are there. Control the controller by increasing the amount of reporting and disclosure to stakeholders. This is very important. So we have to control the controllers, as I said in the case of purpose as well. Control those people who control the organization. How can you control those people? We can control the controller, it means the directors of the business, through disclosures as well as the reports. So in order to control those shareholders, whether they are doing according to the standard or not, so we have to receive report from them. We have to ask them, please provide such kinds of disclosure for us, right? So please provide us a kinds of statements, or please summarize it for us why you have done such kinds of activities, right? So report is one of the way to receive report from them regularly to check that whether they are doing according to our standard or not. One point. Second point, increase level of confidence and transparency in company's activity for all investors, and thus promote growth. Yeah, this is also important. The next purpose of Corporate governance is to increase the level of confidence in the business. And of course, so we have to increase the level of transparency in the business. Transparency regarding activities of the business, regarding functions of the business, whether the directors or the managers, whether they do according to our standard or not. How we can believe on the report which they provide in the form of financial statement, right? So they have to increase our confidence. They have to increase the confidence of the shareholders, the confidence of several other stakeholders in the business, and make sure that whether there is a proper growth in the business or not. Right? That is the case. Next point, which is very important, this one. Ensure that the company is run in a legal and ethical manner. Yes. So we have to check that whether we are doing according to standards or not, whether we're doing according to legal requirements or not, whether we follow the ethics in the business or not. Everything should be matched. And finally, built-in control at the top that will cascade down the organization. So in this case, we have to check that whether the hierarchy is managed in the business or not, whether everyone is following the standard or not. Standard mean, for example, in this case, whether we follow the rules and policies and procedures in the business or not. So the directors, of course, directly they are not involved in the business. Directly they are not involved in several activities. They are making the policies and so on. They are communicating to the managers, managers to the officers, officers maybe to the lower levels and so on. So we have to check that whether this hierarchy is properly implemented in the business or not. Right? So a few more points regarding the needs of corporate governance, as I mentioned here. If there is no proper corporate governance, please be sure that there won't be any successful or any mechanized financial markets. And of course, we cannot find out any mechanized stock market as well here, right? So in order to have a proper stock market, in order to have a proper, for example, financial markets, especially which are linked with the corporation. So there is a need for corporate governance. See, publicly, it is mentioned here, publicly owned companies are run in the interest of the shareholders. The need for corporate governance is to make sure that the public companies are running in the interest of the shareholder. And in order to do that one, it means in order to prove that one, whether the companies or what the public companies are running in the interest of the shareholder or not. So we have to check that there should be adequate accountability. Adequate accountability of which people? Adequate accountability of those people who manage the company. So let me summarize it. Need for corporate governance is there in order to have a proper stock market, in order to have proper exchange market, in order to have a successful stock market, in order to have a proper financial market, right? So we have to make sure that whether the companies are run in the interest of shareholder or not, whether the directors are accountable for their activities or not, right? Whether they show the exact features of the business or not, right? All those things should be followed. This is the point. The basic elements of sound corporate governance include this one. In order to have a sound corporate governance, the following points should be available in our corporate governance. It means that if we want to have a proper corporate governance, so what should we do, or which things should be checked in the company? We have to check the following things. Number one, effective management. We have to check that whether there's effective management or not. It means whether the managers are effectively managing the business or not. Point number one. Point number two, effective system of internal control, whether there is a proper internal control system or not. Point number one, there should be internal control. And point number two, the internal control system should be effective. One point. Point number three, oversee of management by non-executive directors. Yes. Oversight of management by non-executive directors. Non-executive directors are those people, as I said before, who are outside of the business and they oversee or they look the operation of the executive directors as well as the other managers. So executive directors are very important and they are in most of the case they are independent. So they have to check the activity of the managers, whether they are doing according to our standard or not. This is important. Next point, fair appraisal of the director's performance. There should be a proper system to control or to evaluate whether the directors are doing according to our standard or not. Fair appraisal. Appraisal means evaluation. Evaluation of the performance of the director. So what the directors has done in the business, so we have to check those things in the through corporate governance. Fair remuneration of directors. We have to check the remuneration of directors. So they should not receive more than the standard, right? Fair financial reporting. Whether the report which is provided by the directors or managers are fair or not. We should have a proper report, right? Otherwise, so there won't be any successful, successful financial reporting system. And the last one, constructive relationship with the shareholders. And there should be a proper relationship with the shareholders in the business. So what are the basic purpose or elements of this corporate governance? Sound corporate governance or good corporate governance should have the following points: effective management, effective system of internal control, then oversight of management by non-executive directors, then proper evaluation of the directors, then we have to check that the directors are receiving proper salary or not. There should be a fair reporting, and there should be a good relationship between the directors and managers. And there is an example of the UK Corporate Governance Code as well as the US Sarbanes-Oxley Act. And these are the corporate governance in the US, and this is the corporate governance in the United States. You can have a look on this one. Few points are important here. The code provides guidelines on 5 areas of governance, right? So what are the points? Leadership of the company. So what are expected from the leadership of the company? Effectiveness of the board. Board should be effective. Accountability of the board. Board should be accountable. Remuneration of the board. Board remuneration should be fair. And board relationship or relation with the shareholders. So this is the example of corporate governance. We have basically mentioned all of this here. So this was one of the corporate governance which is practically applicable in UK right now. And the Sarbanes-Oxley Act, which is applicable in United States with the following elements. What are the points? Sound system of internal control. There should be a proper internal control. Point number 1. Point number 2. Clear documentation of financial process, risk and control. Proper documentation of financial process or transaction should be available, or in order to have transparency in the report. Evidence that management have evaluated the adequacy and design of system and control. There should be a proper evidence whether the managements were able to evaluate the adequacy of designing a proper system or proper internal control or not. So you have to show that we have a proper internal control and we have evaluated that our internal control system is effective and efficient, right? This should be available. Next point, evidence that the auditor has evaluated the adequacy and design of the system and control. So there should be evidence that the auditors also have checked this internal control system and they have shown that this internal control system was efficient, right? So these are the things that through which we can control the agency problem in the business. Also, I have mentioned a few more points through which you can control the corporate governance. Point number 1, through you can manage the corporate agency problem in the business. So this is one of the ways that you can manage the agency problem. Clear communication of the goal. So you should properly communicate the goal to the managers and so on. And remember one thing, while setting the goal, so you should not consider your own interest or your own personal interest as a shareholder. So you as a shareholder, while setting the goal or objective for the company, please take care of personal or economic interests of the managers and shareholders as well. So in this case, if you consider their interests as well in your goal, so they will focus or they will work toward this one to achieve the goal of the corporation. Why? When the goal of the corporation is achieved, so their goal also will be achieved, right? And please properly communicate the goal to the shareholders. Sometimes there will be a conflict. Why? Because this conflict might be because of miscommunication. So please clearly communicate the goal and tell them that if you achieve this goal, so your goal also will be achieved, right? That's the case. And the second thing, in order to control it, oversee the manager. So always you should control or see, have a look, or re- request them to provide a report for their performance and so on. And the next one is, which is very important, implement compensation plan. Give them some incentive. For example, in the case of companies, you can have a uh, common incentive, which we can call it company stock, right? Or for example, a stock option. A stock option is the option that we, as a shareholder, promise to the directors. If you achieve the goal of the business, suppose 1,000 shares will be sold to you at the lower price. For example, the market price might be, for example, 100, but we will sell you, for example, for 80 each. Okay? But what is requested from you to please achieve the goal of the business. So when the directors receive such kinds of incentive, definitely they will get encouraged to achieve the goal of the business. Why? Because the goal of the business will be depend to the goal of their goal will be depend to the goal of the corporation. So they will focus on the achieving the goal of the corporation. When the goal is achieved, so the company can sell a specific number of shares for the directors at the lower price. Then the directors may sell it in the market or they may maintain it for the future requirement, right? This was the case. And the next one is corporate organization structure. This is the structure. At the top, we have shareholders. Then they elect the directors or the managers and so on. Then the top, there's the president, then president of human resource and so on. One of the vice presidents of finance or chief finance officer. Then under chief finance officer, the finance activities are divided into two parts. Some of the activities are treasurer and some of the activity are belong to controller, right? Treasury and control. So the person who control controller, the person who manage the treasury treasurer. So this activities comes under treasury and this activities comes under controller. So I want to show this one in this figure as well. The responsibility of treasurer. The treasurer is responsible for managing what? Treasurers are responsible for this one, for capital budgeting, for cash management, for credit management, for dividend distribution or disbursement, financial analysis or planning, pension management, insurance and risk management, tax analysis, and so on. All of these responsibilities are responsibility of treasurer. But we are not going to discuss this one in this slide. On the other side, we have controller. The controller manage the company's internal accounting system. They're managing the internal accounting system, cost accounting, data processing, general ledger, government reporting, internal control, preparing financial statements, preparing budgets, preparing and forecasting. These things all are the responsibility of which people? The responsibility of the controller. So this was the topic for this point. So if you have any issue regarding these things, so still we can discuss it. At the top, once again, if you summarize it, the regulatory framework it is divided into two parts. So we should have a proper financial statements. In order to have financial statements, national standards and international standards to be followed. And also we have to go for the corporate governance. What is corporate governance? We said there's a proper system. It shows the relationship and so on. And there is a conflict. There is a relationship, which you call it agency relationship. If there is a conflict, can be called the agency problem, and that has cost, can be direct, can be indirect. Objective of corporate governance, and of course, purpose of corporate governance are mentioned here. A good corporate governance should have the following points, and this was corporate governance of UK, and this is for US, and these are a few more points. Proper communication, checking, and some incentive can control the agency problem. This was the structure, and finance activities are divided into two parts. So this part our point. So thank you.